your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then, Sangeet Lakkar of Newberry Capital, independent investment advisor Vivek Mavani and Kalra of Target Investing join us on the show. Today on Hot Money, we'll discuss stocks like Jubilant Food, Piramal Enterprises, Raymond and Shakti Pumps. Let's start with the first one, and that is Jubilant Food. The counter is trading almost at record highs. Let's see what it's doing today. It's up almost 1%. So clearly there is a lot of traction that's happening on the counter. The big question that we're asking is will the rally sustain on Jubilant Food? So that's the question that we're asking. Sangeet, I'll start with you. A minute, what's your initial take on Jubilant Food?
So Jubilant Foodworks owns the famous Domino's Pizzas franchisee in India and other Southeast nations countries. It also owns Dunkin Donuts. Excellent business. If you see the financial matrix, it qualifies almost all your checklists of ROE, ROCE and stuff like that. However, you have to differentiate a business from an investment case as well. So if you see the valuations, it's trading at close to about 80 times. Though it had reported a same SSG of about 18% in December, but this was coming from a demonetization base quarter. So you'll have to factor that. So purely because of valuations, I would be a little cautious on the stock. In terms of business, it's an excellent business. Okay,
so cautious because of valuation is what Sangeet is saying. Vivek, you have a minute, your opening take on Jubilant Foodworks.
Well, I would second Sangeet's views in the sense that, again, excellent business that performs consistently quarter after quarter, barring few hiccups that they have had in the last couple of years, but something that they can be excused about. But valuations seem like a concern. If the stock declines, which just doesn't generally, but yes, between 2015-16, stock did decline significantly. So if we have those kind of corrections in the larger cycle, larger upcycle or multi-year upcycle, then it's probably an excellent business to hold for long term. But I wouldn't be a buyer at these prices.
Okay, so two of our guests do believe that at this point valuations seem stretched. And Samir, do you share the same view or you have a different view? You have a minute here.
So I think the rally will continue on basis of Q4. Whether it's a valuation issue or not, that depends very investor to investor. Because if you see on the five-year CAGR as in PE basis, it has been 100 to 95 forward earnings kind of a valuation always. Even the listing was 100 times PE. So valuation of this stock since historically has been always high. Otherwise, if you see the Q4, I expect a double digit, maybe not above 18, but around 15 to 12% of SSG with a cash flow generation initially higher, because the Dunkin closures are giving them a very big leg up on the cash flow. And the reduction in the point of additions of new stores of Domino's helps on the cash flow.
Okay, so two of our guests do believe that valuations are likely stretched, but Samir does believe that the rally will continue. So we'll open it up for discussion. Sangeet, I'll start with you. Great businesses have great valuations. Some of the it's a growth process. Like you look at Page Industries, you look at Avenue Supermarket. These companies which are growing substantially higher always have high valuation. So is that not something that you would look at?
Jubilant was the pioneers in introducing this Italian pizzas in India. That's why they demanded a premium valuation. Now, what has happened is, and they've obviously specialized in the home delivery format. Now with Swiggy and other host of home delivery apps coming in, they are slightly losing that edge. And also you have a lot of other small chains into this Italian pizzas which have come up. So I am not sure whether this growth is going here to stay to sustain this kind of premium valuations.
Okay.
So and obviously last quarter's SSG you have to take into account was because of a very low base. So let's see the sustainable growth for next couple of years, and then we'll take a call.
But what according to you is an ideal PE level for Jubilant? Because it's always traded at as he pointed out, 90 to 100 times. So what would be an ideal PE that you would look at?
So I would be a buyer at about 1500, 1600 rupees.
Okay, so that means potential 900 rupee downside. If that comes in, that is the time you would potentially enter. Samir, one of the point which he rightly said is that this 18% SSSG that came was on account of a low demonetization base. Now as growth starts picking up again, the SSSG again probably will come down. So that is somewhere, and it's mostly that is something that the market probably won't like.
See, if you see the numbers, the SSG agreed that it was on the demon levels. But if you see the last 2 years addition of the new stores always happened at the lower base. So any new store which is coming into the SSG, because SSG accounts for 2-year-old stores. So any new system which is coming in will come on a lower base. So SSG will be maintained, I think, from my side for next 4 to 5 quarters. My only plus point, like he's saying, Swiggy has coming in and all. But still, if you put a Domino's standalone, the major thing has been the offer they have introduced, which is a daily offer. Otherwise, the billing of a 2 medium pizza, which was around 300, 350, has come down to 190. So and still they are able to maintain the margins and the costing in every aspect of the P&L. So I'm optimistic about it because they're reducing the average billing and still maintaining the profitability.
Okay, so I think most of the brokerage reports that have also come out have pointed out this 100 rupee pizza that they're talking about could be the big booster. Vivek, very quickly, in terms of valuations, you also found it expensive. What according to you is an ideal valuation for Jubilant Food? Or pretty much what is the price that you would, it's at 2400, what is an ideal price that someone should enter into according to you?
Okay, so on a forward basis, I would be okay with something like around 40-45 times, and that would translate into a stock price on current base of earnings at less than 1500, maybe somewhere in the region of 12, 13, 1400 types. And what kind of growth assumptions we assume for future. I mean, that is financial year 19 and financial year 20. Now, any kind of hiccup in terms of growth rates, which is, to my view also, and there I would agree with Samir in terms of growth actually being sustainable, because if we look at last 2 years, the earnings growth were in spite of losses in Dunkin Donuts side of the business, and those losses are actually coming down or reducing losses quarter after quarter in the last few quarters, and hoping to at least break even hopefully in the 4th quarter. So, and if they continue that journey for Dunkin in terms of Q1 also, it's only an incremental to the profits other than from the Domino's business.
Okay, so that's the view that's coming in on Jubilant Foodworks, which is the first stock. No doubt it's been a marked outperformer, but two of our guests to believe that valuations are extremely stretched at this point of time, while Samir does believe that there is room for the company to grow even further. Let's move on to the next stock, and that is Piramal Enterprises. The counter has been rallying. It's up almost 15% from the recent lows. Is it the time to start buying? It's down almost 0.5% in today's trade, but what's the investment thesis for Piramal Enterprises? Vivek, I'll start with you. A minute. Will you buy Piramal Enterprises?
Well, on declines, certainly for long term, and here I'm actually willing to stick my neck out and bet for the next 4-5 years or even longer. So basically in Piramal Enterprises also, valuations do remain a concern. Valuations are rich, but here I'm willing to take the bet of buying on higher valuations. If the stock does decline, whatever declines are available, for me it's a opportunity to accumulate for a 4 to 5 or year period or even longer. Okay, what about you, Samir?
I will be a buyer even here because see, any declines will be always a motive for me to buy more, and we've been buying this past 3 years in the whole system. Now the only plus point, as in a big booster in next year or next 2 years, which I see, is the pharma domestic business. So they had sold their domestic pharma business to Abbott, and they had a non-compete which is going to expire in FY19 end, I think. So that expiration will bring them back into the pharma domestic business, which is growing at least at 10 to 15% or overall industry levels, even after the clampdown on the prices. And plus their finance business is always growing at a 20 to 25% growth, which I will have a combination if I buy it today.
Okay. What about you, Sangeet?
I am also a buyer. I'll go with the house views. I think it's an excellent company. If you see last decade ROEs, it's been consistently above 20%. So has been the growth rate above 20%. So here is a company which is growing at about 20% consistently with an ROE of about 20%. And having said that, in their financing business, the NPAs are less than 1%. So they are doing their underwriting well, along with managing the growth.
Okay, so I think it's a consensus buy view that's come in on Piramal Enterprises, at least for the long term. We'll open it up for the discussion. So Vivek, I'll start with you. You said you're a buyer. What are the key triggers that you're looking at, which makes this a good investment opportunity?
See, very focused three things. One is no doubt that they have systematically ground up built the financial services business, starting with real estate funding, then structured both equity and debt, focused on real estate, moved to larger spectrum of loans, and now even got into retail home loans, and over a period of time will get into other areas within the financial services space. Asset management, something that they already started, but still small, but just started about a quarter back. So financial services business can continue to grow at maybe 25% for the next many years as new businesses keep getting added. Of course, the financial services will take up a lot of capital also, but one is okay with growth capital being invested and generating superior return on capital and return on equity. As far as the pharma business is also concerned, consistently growing. They have been on an acquisitive mode, which is actually the personality of Ajay Piramal. I mean, if you look at last 25-30 years, he built the entire pharma business out of acquisitions, which was bundled together and like sold off to Abbott. So importantly, it talks about one important thing about Mr. Piramal as an investor, as an entrepreneur, as a businessman, that he is excellent at spotting value, growing, and value unlocking, whether it's by strategic sale or whatever other means.
Okay.
So today what you have in the company is a pharma business and you have financial services business. So there could be some case for a discount holding company kind of a discount, but eventually I will not be surprised if the two businesses are demerged and the two going separate ways. So that could be a very big trigger. I don't know whether the trigger is going to happen in the next 1 year, 2 year, 5 year, but eventually Mr. Piramal, given his track record, will do it. Okay.
Sangeet, he spoke about the demerger being the key re-rating trigger. What, according to you, will be the re-rating trigger for Piramal Enterprises going ahead?
I think demerger is the biggest trigger for re-rating of Piramal, because financial services and pharma businesses are different activities with no connection. So any large investor looking for a focused play would obviously want a more focused company to invest in. So I believe demerger is the biggest trigger for this.
How does Shriram Group fit into the scheme of Piramal Enterprises? Because right now they are just holding stake in it. How do you see Shriram Group fitting into Piramal going ahead? How will the role be there?
So the chairman has indicated that they would be upping their stake as and when the need arises. He is also the chairman of the Piramal of the Shriram Group also. We'll have to, I mean, time will tell what exactly is in his mind to fit in the Shriram Group into the entire Piramal Group. So no comments on that as of now.
And any risk if someone is ready to take a bet on Piramal Enterprises, any risk that you foresee?
See, given the track record of the management, they have displayed their capabilities of execution. They are also entering into the reality space now in a big way. And my sheer parameter to judge an NBFC business is the NPA. If it is less than 1% and if growing at about 20%, that itself talks.
Okay. One final quick word, Samir, before we move on to the next talk. What about, isn't Piramal, putting their hands into too much things at one time? There's pharma, there's financial, they're getting to real estate financing. Then they have this AMC nod, and then they have home loan financing. So isn't it spreading too wide instead of being a concentrated bet?
To a certain extent, yes, but the only point is they hire professionals to run those businesses.
Okay.
They're not running themselves, or they're not the individuals who are running the system. If the professionals they hire, as their track record has been, is good enough, I think they can manage that.
Okay, so I think it's a consensus buy that we're getting in on Piramal Enterprises from all three of our guests. So that's the stock that you need to clearly watch out for. The next stock is again, you know, an outperformer. It's up almost another 3-4% in today's trade, and we're talking about Raymond. From the recent lows, it's up almost more than 10 to 15%. So above the 1,000 level, is it the right time to start buying Raymond? That's the question that we're asking our guests. So Samir, I'll start with you. What's your view on Raymond? Will you buy?
So I won't buy Raymond because I'm eventually buying just the fabric system, which I'm not very optimistic on, because the branding apparel is very small over here. So I rather go for a Arvind rather than the Raymond, because if you see now, the majority of EBITDA is coming through the branded textile, which is a new system for them to sell a branded fabric. And now that is, you have a lot of debt on the books. Your net working capital days are around 100, 105, which are not ready to come down to even 90 to 95, which will give a big boost to reduction of debt. So I'm looking more towards reduction of debt and cash flow, where I see no scope right now when you're expanding into even auto components and other avenues.
Okay, what about you, Vivek?
Well, I'll just give you an analogy. I mean, in the market, we have a choice between losing an opportunity and losing money. And in case of Raymond, even if there is an opportunity, I'm willing to lose it. Quite honestly, I'm willing to let go of the opportunity simply because I don't want to bet on this management, which really has a terrible track record over the last 30 years for multiple things that they do or they don't do, whichever way one looks at it. So management issues basically keeps me away from a business which is extremely good. I mean, it's a terrific business in terms of branded textiles, ready-made garments, suits, and all of it. So I would rather be a customer for their products rather than be an investor of their product for the company. And it's all about the management. I mean, we can revisit that later. So irrespective of whatever the valuations, whatever the growth, whatever the outperformance of the stock price, I'm just willing to let go of that.
Okay, so two negative views, and what about you, Sangeet? Will it be a third negative, or would you be a contrarian?
So I don't track Raymond's, but what I'm positive on is a company called V2 Retail, which is in the same space. So the rationale is that if you see last couple of years, what is actually happening is there's a lot of growth which is coming from the tier 2, tier 3 cities. Though we have been talking a lot of urbanization, the premiumization trend and all. But if you see, so even for instance, the tractor sales for March were up about 50%, even though we have been talking about farm distress and stuff like that. So here's a company called V2 Retail, which is into apparels and very focused on setting up outlets in tier 2 and tier 3 cities. Stupendous growth over last couple of years, great management. More positive on V2 Retail. I'm not tracking Raymond's as such.
Okay, so that's the view that we're getting in. Two of our guests don't like Raymond at this point of time, but Sangeet says he would prefer a V2 Retail. So we'll open it up for discussion. So Samir, you're saying that you're playing it, but Raymond has significant amount of other businesses. They have this FMCG engineering, which the management on record said that if we're getting the right value, we are ready to sell those businesses, and they are in the fast growing business. And clearly they have this land bank with them. So how can you just say that, you know, it's just on one thing, because there are multiple things in Raymond?
See, the only point is right now the P&L, what it shows, you can talk a lot of things, but your P&L shows that your majority revenue and PAT is coming from two of the sources. One is the branded textile and one is the actual traditional fabric business which they do. Now the EBITDA expansion, what is happening is coming from branded textile. Other what they are talking about is the auto components. That's hardly a 100 crores or a 70 crores kind of a revenue right now, and it takes more of capex. It takes more of debt. So already on the leverage book, if you're doing more leverage just to create a value of new other ventures which you might sell off tomorrow, then you're just using the cash flow which comes from a. So I rather use that cash flow to pay off my debt and become a debt-free firm, and automatically my PAT and everything grows automatically. So I see a strategy difference between what as an investor I want out of it and what actually they're doing.
Okay, Vivek, coming back to the management issues that you were saying with the management right now, I think the stock started rallying post the management changes that happened, where Gautam Singhania has taken the back seat and he's got in a professional management to run each of his verticals. So is that something that will not give you confidence that the promoters are not meddling into the company businesses now?
Well, the quality, let me revisit this, something what I said a while back. A terrific business, unmatched brand equity, unmatched distribution network in terms of penetration, in terms of their own stores as well as through other retail outlets. But the business is just not adequately profitable to generate a return on capital which is respectable for a branded business of the type of Raymond. And if I were to draw parallels, I mean, Keval Kiran, which makes killer jeans, and they've got a couple of other brands in casual wear, generates 20% plus EBITDA margins on a 500 or 550 crore top line. Raymond's branded garment business under Raymond itself, the Raymond suits, ties and all, Park Avenue and Color Plus, all three put together is close to 2,500 crores, hardly makes money. So company 1/5 the size makes 20% EBITDA margin. Indian Terrain, again the branded business in menswear and kidswear, generates EBITDA margins of 14-15% on about 400 crores. Arvind's the branded business is in the process of getting demerged. I don't really have the exact numbers for Arvind, but what I understand is it's a close to 1,200 crore business, and it's profitable. What is important is profitable. Raymond is not. So Raymond is, or everybody else put together is equal to Raymond in terms of branded business, and yet loses money. And I fail to. I've spoken to people within the branded garments business, including the managements of Indian Terrain, management of Keval Kiran, and they say it's actually really difficult to lose money in this kind of a business, especially if you have the pricing power. And so that is what keeps me away.
We're running out of time on this thing, so I'll have to stop you at that. But clearly, I think the consensus view that we're getting is all three of our guests. Sangeet doesn't track Raymond, but he prefers the V2 retail. But the other guest not clearly liking the Raymond story. And the final stock that we need to cover is Shakti Pumps, stock at a fresh lifetime high. There is enough traction. The counter is up another 2% in trade today. Will the rally continue? Sangeet, I'll start with you. You have a minute on Shakti Pumps.
Yeah, so I'm bullish on this stock. Now, this is a niche player, and they command about 80% market share in the solar pumps. So they traditionally used to be in diesel agriculture pumps, but of last couple of years they have diversified into solar pumps, and they claim that they are having about 80% market share. Now the government in this last budget has launched a Kusum scheme, which is specifically for solar pumps. They are targeting about 3 crore solar pumps to be installed by 2022, which is an enormous opportunity for this company. The management, though not very professional at this stage because it's a family-run company, but I think once they reach that particular scale, I think that issue will also get addressed. But it's a play on India's agriculture sector, it's a play on the renewables energy in some sense. I think this year they are expecting about 2 to 3 lakhs pumps to be tendered.
Okay, so your time is up, but I'll come back to the point that you were making. Samir, your view on Shakti Pumps?
So I'm positive on the rally continuing from here, but on the short term, in anticipation of Q4, because if you see the numbers, there's seasonality of December and March quarter being highest quarters, and June and September being lowest, because June is more monsoon, and it extends to September also in terms of filing. So the rally will continue in the anticipation of Q4, but as he said, you know, there's a huge opportunity between the solar pumps. Now my only thing is, how do you capture that? Because you need capacity also to ply with that. If they have a sufficient capacity running on those solar pumps, or they leverage out to take that opportunity, I would like to see that before I take a longer term bet.
Okay, so Samir is saying that he would like to see, you know, the further financials and capacity expansion before he takes a bet. And Vivek, what's your view on Shakti Pumps?
Well, actually, I don't track Shakti Pumps, so I don't really have a view. But as far as agri theme is concerned, yes, next 2-3 years, agri as a theme, agri and rural as a theme is a meaningful investable opportunity. And on your program as well as on other occasions, I've indicated my bullishness as well as an interest in personal as well as clients' investment interest in Swaraj engines. So I would play the agri theme by way of Swaraj Engines, which supplies tractor engines to the Mahindra Group's Mahindra's North India tractor business.
Okay, so Vivek says that he doesn't track Shakti pumps, but he will play it via Swaraj engine. So I'll come back to you, Sangeet. You can finish your point. I think I interrupted you.
No, so just to address Sameer's point, the current capacity utilization is only about 50%. So there is a huge operating leverage which will come into in next couple of years as and when their order book increases. You know, so that addresses the capacity constraints. My only concern in this company remains the management, so to say, because it's a family-run business. I would obviously like it to be a professional-run business for it to give higher multiple or a higher re-rating. But definitely the opportunity size that we are talking for solar pumps is immense.
What about competition? How are they placed compared to competition in this solar business? Because I think they are one of the first ones to get into the solar pump, which is where the rally actually started. So how are they placed compared to competition?
So the management claims that it has about 75 to 80% market share in this solar pumps category. That is substantial market share that we are talking about. And also the efficiency of the pumps, of the Shakti pumps, is about 20% higher to the next competitor. You know, so I think these two facts kinds of addresses the competitive, you know, as of now at least.
Okay, and the risk that you said was management. So is there any risk that you have on the current management, or I just want you to specify what do you mean by on that terms?
So it's a family-run business. As the company is out of Madhya Pradesh. It's a family-run business. Obviously, there are a couple of issues in terms of the shareholding and all, which I don't want to bring it up in a public forum. But I would interested obviously if there is a professional run management in this company.
Okay, and Sameer, in terms of competition versus Shakti, do you have any view on that? How and the future outlook for Shakti?
See, my only point is, if it's such a big opportunity, what stops from any other person just to bring that pump from China and sell it out here? As in, what stops the competition being from aggressive if that opportunity is such big? And if a PE fund company, because everyone's more interested in renewable energy companies now onwards. So I think, and secondly, if they're still sitting on the 50% capacity utilization, what's the reason for that? Because if the opportunity is coming in and they're able to win the orders, so somewhere there's a disconnect between the opportunity and the company progression. So if that discontent reduces, I would like to see that.
Okay, do you want to respond to what he said?
So it's a new category which has been introduced. It's just about 12 months to 18 months that they have started this solar pumps in a big way. So obviously it will take time for them to ramp up their capacity and utilize the same.
Okay.
You know, so it's a niche area.
So we need to watch out.
The Prime Minister also in the month of March has specifically alluded to the fact that solar pumps is something which is very high on his mind. You know, the Prime Minister of the country is specifying such a clear, vision statement for such a niche product. Gives me a lot of, comfort.
Okay, so I think Sangeet is bullish on Shakti pumps. Sameer is saying it's a wait and watch, and Vivek is saying that he doesn't track, but via proxy play, Swaraj engines is something that he likes. With that, it's a wrap on today's Hot Money. Sangeet, Sameer and Vivek, thank you so much for joining me on the show. Ask BQ comes up next. Stay tuned to Bloomberg.